Hey all, happy Tesla Investor Day, but I'm going to do real estate first because you guys have been asking for this and it got a little bit rescheduled. But this will be, and always is, the most comprehensive global view of the real estate market anywhere on the internet. And there's a ton of information. God knows, there's probably 50 nuggets today, at least. But we cover everything, and I'm doing a couple of interesting things too as well. I'm comparing real estate to Bitcoin and real estate to the stock market and real estate to gold. And see who wins. but is real estate worth having? Yes, of course it is. Let's just jump in. And thank you all for being here. Thanks to the mods in the chat. I see you out there, Benny. Good to see you on Fourth Turn. All the usual crew. So let's jump in. March 2023 edition. And of course, not financial advice. And as you know, in this channel, I believe in what I call the three-legged stool. I do everything in threes: equities, real estate, crypto. And this is one of those legs. And it's very important. It doesn't move as fast as other assets. But boy, it's very easy to project sometimes. So first of all, let's look at the size. A quick reminder for how big this thing is. It's massive. The global real estate market is about 340 times the size of crypto. It's worth about 340 trillion, depending on who you ask. And commercial is about a tenth of that, 34 trillion. We will be talking a bit about commercial real estate too, as well as some of the changes that are happening in our world. And remember, real estate is the number one choice of millionaires. Everybody needs to have a little piece of real estate in their bag. And remember, 340 trillion. US GDP is worth about 80 trillion. So real estate alone global real estate is 4 times the size of US GDP. And it's about 35 times the size of all the gold that's ever been mined. Interesting numbers. So the question is, I talked about this before as well in all the other episodes, and the reason I started doing this is people ask me, when is real estate going to crash? I want to buy some, etc. So the question is, which markets are coming out and which ones are still crashing? And that is interesting to see. So first of all, let's look at US real estate versus gold. For all the gold bugs out there, I put together this chart using our macro benchmark model, and it compares US real estate divided by gold and using the benchmark model to compare that to actual gold performance. So basically what the model does, it tells you when it's red under the blue line, that means red means gold is beating real estate. But if you look at the past, say of the past, I guess 10 or 11 years, real estate has been beating gold handily 85% of the time. So that's interesting. The gold bugs will tell you gold is the best performing asset, but no, real estate beats it. And with real estate, you get tax write-offs. And you can leverage it heavy by having just 20% or 10% down. We'll talk more about leverage as well in real estate. Let's look at real estate versus the S&P 500 again, using the macro model. This is really cool to get a feel for where things are versus where they're not. So green means real estate is beating the S&P 500. And you can see it did that handily in the early 2000s, past the dot-com bubble, and running up to the global financial crisis. And then it came crashing down. So you see green spikes like that, you know to hedge your real estate, get out of your real estate, etc. But basically, ever since the global financial crisis, the S&P 500 has been beating real estate with a few very tiny exceptions. You can hardly even see them on the chart. So again, okay, real estate beats gold, but the stock market over the last decade or so beats real estate. But the question is, what about Bitcoin? Well, it's a bit of an unfair game, but orange means Bitcoin beats real estate, and blue means real estate does beat Bitcoin. If you're pair trading them, it would be beautiful to be in a world where you could pair trade real estate on the fly. It'd be handy. But you can see ever since 2020, can't read that number very well, but basically since 2022, there's been a bit of an uptick where real estate has actually been beating Bitcoin, only up to a certain point, of course. So let's talk about, now we're going to dig into, a quick tour of the world as I juggle slides around here. We're going to start in the US, then we're going to go to Canada, Germany, China, etc., and a few other markets, UK. Basically, the markets that I analyze are representative of the audience. If you have a country that's missing, I know Benny's in the Netherlands, you want me to do an analysis, I will include it on the next review. So let's start with the US market. And again, as I always say, what happens in the US actually can be representative of many other markets as well. So let's talk about macro stuff first and where we are. So here, the US median home price is down 13% from June 2022 from the peak. Okay, median price. We'll dig more into how that breaks down over different values of assets. You know, lower priced homes, like lower priced cars, will always sell first. It's the expensive ones sometimes don't, but we'll dig into that. Now, another view of price, not median, but the average sales price is now 16% off the highs. We look at this chart as well from White Charts. Thank you, Charlie Bilolo, as well for doing this, and Sanjay for sharing. You can see the global financial crisis and how we came 25.56% off the highs in 2009, 2010. But ladies and gentlemen, guess what happened in the year 2010, 2011? That was a great time to buy real estate because real estate just boom, bombed again. Right now, we're at that 16% mark. The question is, will we go down that low? I'm not sure, but there are things happening that we need to look at to give us a better answer to that. Let's look at what's happening and what the Fed have done. Although they are living 6 months in the past, they won't know the damage they've done till, I guess, summertime 2023. But anyway, here you can see US existing home sales, seasonally adjusted annual rate on this line, October 2010, May 2020. The reason the market died in May 2020 was people were locked down. They couldn't get out of their homes for whatever reason that was. And here we are right back at that level again. While prices falling have helped support some sales of existing situations, we are at the GFC levels, we're at the C19 levels, and I believe there is more pain coming. While the price declines did help, the 16% drop is simply not enough. And the math supporting that statement, 3 years ago, the 30-year mortgage rate was 3.45%. Some people got 30 years under 3%, including the guy here talking. And the average new home price in the US was $384K. Today, you have a 6.5% to 7% 30-year mortgage rate with an average home price of $474K. The result is an $18K increase in the required down payment, assuming 20% down, a 75% increase in monthly payment from about $1,300 to about $2,400. It's $1,100 more. It's huge. And that doesn't include property taxes, insurance, utilities, repairs that have all gone skyrocketing. In fact, I even touched on the increase in utilities yesterday's video in California. You know, in 4 or 5 years, it's up 68 to 86%. It's ridiculous. Anyhow, everything's getting more expensive. And does the Fed control inflation? No, they don't, but they do destroy demand. Let's look at other markets that have dried up. The ReFi market in the black line here, the refinance index has gone to zero. Nobody is refinancing anything they have, even if they're on a virtual ARM type mortgage, a variable mortgage, I should say. They're just sitting on it. There's no point in going anywhere. They're waiting for the market to come back. And the Fed today rattled the markets to say we're going to be higher for longer. So here we go. We'll talk more about those guys in a minute. This is the change in sales from 1 year ago by price. So you can see here the 0 to 100K home sales. I don't know where you buy a $100,000 house. Well, I do actually. I'll show you in a minute. But you can see they're down 25%. 100 to 250K down 35%. 250 to 500 down 31%. $500,000 to $750,000 down 33%. And the more you go up, the higher you go up the food chain, the more these change in sales comes down. So 750K to 1 million down 36%, and 1 million plus down 41%. So I wonder what the 25 million plus homes are doing these days. Now there's also some inventory buildup. This is the list of inventory for completed homes for sale in red. It's about 68,000. It's more than double the record low of 32,000 in 2021 and early 2022. And this is getting close to the normal level of completed homes for sale increasing. That's kind of good news. But the inventory of homes under construction, blue at 280,000, is very high. That's 11% below the cycle peak in July 2022. And the inventory of homes not started is at 91,000. Now, the problem is you got these people either building, things are under construction, or about to build, and they can't sell them. But they need to flip them fast because they can't sit on dead money. So that's another interesting dynamic. Also, I believe there's more pain to come. Thanks, Fed. You're doing a great job. as the Federal Reserve continues to raise rates into 23. A lot of jawboning today saying 50 basis points next, higher for longer, yada, yada, no cut until 2024 at the earliest. And one sector of the economy feeling the most pain, of course, is housing. Housing is completely, utterly, 100% sensitive to interest rates. And as interest rates rose in 2022, so did mortgage costs, cutting affordability for many, blah, 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 blah. Here we are. 30-year mortgage now close to 7%, dropped back slightly, but the Fed want to take it higher for longer. And they've already smashed the market. And I'll show you so many charts to do that. Now, what people are trying to do is kind of an interesting one. Ever since C19, there was a time when everyone wanted to upsize because they're working from home, etc. Now there's a new trend where people want to move towards tiny homes, tiny mobile homes, tiny small houses. And California, because there was a shortage of houses for a while, they were allowing people to build in people's back gardens. So building a small, what they call ADU in people's back gardens. Now, ADU is an acronym. It just slipped my mind what it is. Oh, I forget the term. But anyway, okay, I'm on a 36-hour fast, so that's why my blood sugar is running low and I forget. But anyway, Google ADU, I'll do it afterwards. But here, there's about $70,000 is what it costs, as far as I recall, for one of these ADUs. It's a tiny home, and over 65,000 of these have been built in California gardens over the last 3 years. That is stunning. And people are really struggling, not being able to buy a home. They're struggling with rising rates. And now people are buying these little ADUs. They're adjunct dwelling units or something, adjacent dwelling units, stick in the garden. I don't know what the A is for, but the rest is coming back. Now, the other problem is people want to still put nothing down because they don't have any savings, don't have any money. And zero money down strategy is typically a bad advice when prices are going down because you don't want to be foreclosed upon in this market, ladies and gentlemen. Real estate strategies, what they call like wholesaling, have exploded in popularity in recent years, but they're not viable right now because the prices are falling. And I believe in borrowing as much as you can at a low rate, fixed, but make sure you have that buffer, so you need to put something down. Do not go into real estate without having a buffer, ladies and gentlemen. In addition, remember this, as Plautus said about 2,300 years ago, or 2,200 years ago, you must spend money if you wish to make money. Okay, there's another fun one as well. Is scared money don't make money, but a lot of fun ones as well. So remember that too. Let's talk about some of the bad news happening as well on the commercial front. This is 2 office landlords defaulting, maybe just the beginning, with at least $92 billion worth of office mortgages maturing this year. Landlords are under increasing pressure. One of the biggest landlord groups is Pacific Investment Management, and they just defaulted on $1.7 billion in mortgages notes, and that sent shockwaves through this troubled part of the real estate market. Offices are empty. Nobody wants to go back. Nobody wants work 9 to 5 in a cubicle anymore. People are leaving big cities. Big cities are hurting. And now they're trying to scratch their heads and figure out what to do. But guess who else is potentially defaulting or renegotiating things? This is having a cascade effect. Even Elon Musk, he'll be on live, hopefully in about 12 minutes. One landlord sued to collect $136,000 in missing rent. Columbia Property Trust, I think it was. They defaulted in his loans tied to 650 California Street, a building I know very well in San Francisco, where Musk leases the 30th floor in the Hartford building, I think is the name. And Twitter's problems have now become, he's saving as much money as he can to save the business. And it's allowed for that. And that's the risk that landlords take on. But even Elon Musk knows how to play hardball with the landlords and renegotiate stuff. Apparently, he's also cut out janitorial contracts, eliminated massages and free lunches and all sorts of office swag. So he's really dropping the hammer on the Twitter business, and this is one of the elements. But if he is not paying his rent, can you imagine how many else aren't? In addition, the big news, a big thank you to Preston as well for sharing this with me. Office bust. This is the top trend of 2023, office building bust. A study from Cushman and Wakefield. I have actually leased properties from those guys before. They estimate $1.1 billion of square foot office space will be unused by 2030. That is crazy. So the big message, one of the big learnings here, if you are involved in office space real estate, get out. And we've been talking about that for a long time too. In addition, US bank real estate loans soar 3x in the past 20 years. Obviously, US banks have huge real estate exposure, and in a tanking market, delinquencies are next. No doubt about that. $5.4 trillion in value that could be on the brink as well. Thanks, Fed. They're smashing everything. And a very cool little graphic as well, where construction is happening. From left and on the side, those that don't know the US map, you can see that's Arizona with the big blue dot. You got 3 big blue ones in Texas. Then you got Alabama, Georgia. Probably most of that construction is happening in Georgia. Then the Carolinas, and then the tri-state area. I'm shocked to see Florida down the bottom right corner so low and so small compared to the West and others. But this is what I always talk about. Watch the migration patterns of human beings. Watch for the cities that are embracing growth. Less rules, less restrictions. Look at Tesla moving to Austin, Texas, etc. And this is also ratified with this little chart here. Population migration. It's funny, the red states are what they call right states, like Republican type states, and then blue states are Democratic. But in this chart, you'll see complete different things. California's red because people are leaving and they're moving to the blue states, the Nevadas, the Texas, the Floridas, etc., the Carolinas. That's where the bodies are going. The Idahos, all those types of places. It's crazy. But there is also a direct correlation between the political parties and how they are mismanaging states, which makes me a little bit angry, everybody. What they've done in California is inexcusable. How they still have, any of them still have jobs, especially in San Francisco, I've never understood. Anyway, off the soapbox, let's switch gears. Let's go to the UK real quick and see what's going on over there for our friends in the UK. UK, renting is now cheaper than buying. Again, when we go through all the stuff, there's lessons to learn here, and it'll help you understand when you do play the real estate game. Take your time, study a lot of these types of numbers, because there are situations as well when rent was far more expensive than buying in San Francisco, and nobody thought of buying, and that was an opportunity. So renting a home in the UK is now cheaper than taking out a new mortgage to buy one for the first time in 14 years, according to, I think, Capital Economics. And they expect mortgage costs to exceed rents until the second half of 2024. So there's time, everybody, to play the game. And the gap predicted to have widened further in the final 3 months of last year. So that's interesting. In addition, like everywhere else, UK home loan servicing costs is going through the roof. Effective rate on new mortgages in the UK are now up from 1.5% in January 2022 to nearly 4% today. And that is a massive move. It's a bone-crushing move, ladies and gentlemen. UK housing cooling as well with surging rates. Obviously, price of financing goes up. The price comes down, directly correlated. And many expect a big slump in UK housing prices in 2023. And activity in the market completely cools. It hasn't gone negative. Remember, this is in local prices too. Remember, the pound has actually fallen a bit as well. So if you took it in another currency term like US dollar, this would actually be negative. But it has fallen by about to 5.3% by mid-Feb. House prices have already fallen month on month in official data, and mortgage approvals have also slowed to a halt. And they're slowed to the same level during the C-19 lockdowns. So again, we're seeing the same patterns. Everything is stopping very quickly. Let's go to the German market real quick. This is an interesting one here too, for those with a calculator. The German market is correcting slowly. This chart here is German residential property price index in blue. The light blue is the overall property index, and pink, German commercial property price index. Again, commercial is tanking. We've been warning about tanking commercial property for a long time because of what has happened since C-19, and it's very clear now it's happening in Germany. But let's talk about residential for a while. For the German housing market has completely frozen to a large extent. Mortgage volumes and construction activity has collapsed. And the reason is the gap between real estate prices and rent development. And we're going to talk about that right now. And I'll show you exactly what that means. So the markets are great because they have a way of balancing themselves out. But if you look at this here, this is the absurdity of the German real estate market in two charts. This is the first chart. Rents in a major city is now about 14.77 euros per square meter in new construction. And old construction is about 11.99, call it 12 euros a square meter. So obviously, new buildings, people are willing to pay more for. But when you skip ahead, the real estate asking price at about 8,200 euros per square meter makes 2.16% rent yield. And you can make money on 2.16% rent yield when mortgage rates that these commercial entities were able to get at 0.8%. But now at 4%, they're smashed. Okay? So what happens next? And that means the prices will come down to map to the actual interest rates. It's only a matter of time. Canadian market is an interesting case in point, because I did say at the beginning, certain markets are crashing, certain markets are not. Guess which one is not? And guess why? Well, let's look at this in detail. So Canada, they did have a 25% decline in Canadian home sales, 666 in 2021. That number's for you, Benny. And you look now, in 2022, it fell to 498. That is a 25% decline. So yeah, home sales are down, but prices are holding up in 2022. Maybe they'll come down a little bit in 2021, but the question is why? You know, June 2022 was the top of the US market. Canada's just over the border. Why is it holding up so well? And in fact, it's actually still going up. It's kind of remarkable. And then the interest rates as well on mortgages are going up in Canada too. So the inventory is also very scant. But if you look at this chart here, you see the yellow piece at the top. That means it is a seller's market when there's more inventory than buyers. And we're in that balance. We're at the top end of the balanced area at like 59 score, which is where the Canadian market normally hovers just beneath. And then the buyer's market is when it goes way down to that area. So it's kind of balanced. But what is going on? And the answer is very simple. Money. Billions in unknown funds flowing into Canada's housing market from Transparency International. This explains how the Canadian market is holding up. This article, basically in a nutshell, talks about how global investors, Chinese investors, and banks have turned the Canadian real estate market into a Ponzi scheme. Realtors and banks see no problem with this. What the hell is wrong? This is kind of dirty money, weird money, all flowing into Canada and has been for a long time. Or people trying to hide money from their domestic countries and they're parking it in Canada. So that's why Canada's holding up so well. Good job, Canada. Let's switch gears to China. This is what we refer to as the most crowded trade. I know I hear groans. People say, oh, China, China. It's important to watch the fastest growing economy in the world and what they're up to, because that impacts things like Bitcoin and crypto, money flow, liquidity, etc., stock prices. That's why we look at this. So let's look after the China's housing market was smashed, the developers are beginning to slowly buy land again after doing nothing in 2022 because the market was smashed. So we were talking about how the Chinese market is rebounding fast, etc. It is, and that's a good sign of it too. Let's look at some data. This are the number of residential plots purchased in 2022. Absolutely zero. Dead market. But it's rebounding fast in 2023. And look at that amount of plots that were bought in 2017. Huge. But the decline, again, the trend, you can do some TA based off this chart as to where things are going. The trend is your friend, everybody. Let's look at Hong Kong, an interesting glimmering point, which could be the new crypto capital as well. Hong Kong real estate rises 0.6% in January, which is huge. And private home prices in the financial hub did fall, I think, about 15% in 2022, but now they are rebounding, despite increased mortgage costs as well in China. So with that, quick conclusion, everybody, a quick summary for you all. Get out of commercial real estate if you own office space. Just get rid of it. The future is bleak, many people say. Maybe unless you are in a very fast-growing city. Be ready for the bottom. We don't know when it's coming, but we have to see what the Fed do. But they're continuing to destroy everything. Everything is ground to a halt. But when prices do fall down, everybody, when prices come down to a level that make it very, very attractive for buyers, a place could be selling for $600,000 now. If it falls to $500,000, the buyers will flood in. where the buyers will come from other parts of the country and migrate to take advantage of the deal. So remember, we could be close, especially after 16%. I always say, typically during a real estate crash, real estate only falls by 20%. So we're 4% away. Not bad. Be ready for the bottom if you're looking to buy your first castle. And real estate is a great hard asset to own. As I mentioned, it beats gold. Sorry, gold bugs. It's just data. And still, there is a housing shortage in many sought after areas. Again, follow the demographics, follow the migration patterns of humans, and plan your location ahead of time. Follow the bodies. And the Fed has really crushed the real estate market. So with that, everybody, 1 minute to go. Tesla Investor Day. Did it on time. Thank you all. That was 48 slides. See you all tomorrow. And I might make a summary later of Investor Day if it's exciting. Let me know if you want me to do that too. Okay, so thank you everybody, and keep planning ahead. Talk to you soon.